Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq. Joining us for this segment, we have Andy Pratt, Director of Investment Strategy at Burney Company, a Virginia-based SEC-registered RIA founded in 1974. Andy, it's great to have you with us. Welcome to Trade Talks.
Hi, Jill. Thanks for having me on.
You got it. Tell us about Burney Company and your investment style that's employed.
Yeah, sure. So Burney Company is, an RIA, as you said, based out of Reston, Virginia. We've been in business since 1974, and our core focus has always been on investing in U.S. equity strategies for our clients. So we've spent, historically, we've spent our time offering our investment strategies as separately managed accounts, but over the past year, we got serious about launching an ETF. And so in October, we launched the Burney US Factor Rotation ETF, doing an SMA to ETF conversion that ended up totaling about $120 million in client assets.
So let's talk about small value for a moment, because I know that's one of the strategies that you're employing right now. Is a small value investor able to stomach long periods of underperforming market indexes, and how can this challenge be addressed?
Yeah, it's a great question. So in the academic literature, there appears to be the existence of a small cap premium. That is, smaller companies tend to do better than larger companies over the long run, and a value premium. That is, cheaper companies by metrics like price to book value and others tend to do better than their more expensive growth counterparts. But the problem is that relationship is not always stable in the shorter term. And in fact, we just went through a time frame where growth, and especially large growth, did much better than value. And I think it's important to keep in mind that over the time scale of the markets, a 3, 4, or 5 year time period really isn't that long, but on the human scale, that can feel like an eternity. So the question that we have is, can that small value investor who may have confidence in the academic literature supporting their position, are they able to stomach such long periods of underperformance?
And when we think about this 3 to 5 year time frame and what we're seeing with market volatility now, explain to us the value of stock selection.
Yeah, so I think it's really important to get that first piece right. So when we're talking about your positioning from size and style, that's the first thing that you have to get right. But that isn't to say that stock selection isn't important, and it's actually the thing that our firm was founded on. So our company founder, Jack Burney, his passion was individual stock selection, and he used his engineering trading from the Army to start developing stock selection models back in the 1950s, using little more than a slide rule calculator and financial newspapers he would find in the library to build stock selection models and predict what type of stocks would do better. And so we kind of take that legacy today, and we still use that general way of thinking when it comes to our stock selection model. We do use slightly more computing power than a slide rule calculator, but we still break down stocks into individual factors like value, profitability, growth, momentum, quality, to build long-term models. But that being said, I think it's also important to stay on top of trends and alternative data sets that are out there. So really, in the past couple of years, we've begun experimenting with an alternative data set that uses it scrapes the web to try to estimate a company's digital footprint, and then uses that information to predict how it's going to do on earnings. So the way that we're using this is we're taking this more short-term big data alternative data set and melding it with our more traditional stock selection model to help inform us on what look like good long-term opportunities, but also when should we enter them. But again, I'll caveat all this to say that you can have the best stock selection model in the world, but if you're trying to pick growth stocks in the value phase or value stocks in the growth phase, you're going to have a tough time.
Well, I mean, Andy, there is something to be said about the old school manual stock selection process, and marrying that with the data and tool sets that you have now. It's almost like if your GPS dies in the car, right? Do you know how to read a map? So I think it's important that you're still able to use those old school processes as well, especially when you look at stock selection, which tends to be very fundamentally based. So to wrap up here, how would an investor use BRNY?
Yeah, so going back to our most recent experience in the markets, that small value investor, they either had to deal with a very long period of time of underperformance or change investment strategies. And it had to be really tempting in 2020, and especially as we ticked into 2021, when growth investments were doing so well. They were even rebranded as like innovation. That had to be so tempting to pull the cord and switch. But as we know, this year, growth has really struggled both on an absolute basis and relative to value. So really the goal of BRNY is to take the guesswork out of investing for allocators who might be tempted to switch between pro growth and pro value. And it's really meant to be a flexible strategy for both investors and financial advisors alike.
All right, we appreciate the insight, Andy. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.